Happy New Year, everyone. This is Ivan Alon. I'm the founder and chief investment officer, head of research at AWAIM. I'm coming to you live from Hong Kong right now, our Hong Kong office. Of course, we still have our headquarters in Los Angeles. And I just submitted my first article to my Forbes editor for the year. And what it hits on are three major themes that we are quite concerned about as we move into 2026. 2025 was a very good year for our client portfolios, and we're very happy about that. Our allocations across asset classes worked very favorably for us, and so we're going to continue to ride this theme, we believe, into 2026. And the key three themes that we hit on are the AI reality. Is there a reality check that is coming due in 2026? Also, the accelerating erosion of dollar hegemony. Is the dollar going to have further devaluation, maybe have some stability, or will it actually gain some strength in 2026? And then also looking at a technical vulnerability of the record amount of leverage that is in margin debt within the United States brokerage accounts. So these are three really critical issues. The first being AI is no doubt, and we agree 100% that it is a revolutionary technology, just like the internet was a quarter century ago. Having this new innovation is a phenomenal thing, but we believe it will take some time across industries and across many, many layers of operations within each company, within each industry, to fully maximize the productivity gains that are available with AI. So AI is a great tool. It's going to be a great support for businesses and operations, and we believe wholeheartedly in that. And we see it impacting industries like financials and utilities and industrials in really incredible ways. The big question is, with all of the invested capital that has been made already into AI from these huge behemoth industries, which you all know the names of, household names, are investors going to feel satisfied by the ROIC that they see from that, the return on invested capital from these major capital expenditures that these companies have made? So this is the big question mark, and are investors going to get a little irritated that maybe they're not seeing the returns on that invested capital that these companies have made? Are they going to get a little peeved? And when investors get a little peeved, they pull their money. They sell. And certainly a lot of people that have invested have made some very good money, and maybe there's going to be some taking of chips off the table, and perhaps there's an acceleration of that. And one of the accelerants could be the third item that I mentioned at the beginning of this, which is the technical vulnerability around record leverage. And that what we've seen in our research is that as the S&P 500 has gone up over the past few years, really past 3 years, that also we have seen really tremendous increases in margin debt as well, almost going up in lockstep. Very highly correlated for many years when you look at the S&P 500 returns and the value of the S&P 500 to margin debt. And we've seen quite a high correlation as well. And so the concern is that people are really fully leveraged within the AI play. And so not only have they been riding up the stock, they've been borrowing against that stock to buy more of that stock. So it works very well to the upside when things are going well and people are buying and borrowing to buy more. It also works the opposite when people start to sell and unwinding those positions and unwinding the leverage around those positions. So it could function like an accelerant to the downside. This is our big concern, and from a risk management standpoint, it's something that we're steering clear of. In our portfolios, we have a significant underweight specifically to IT because of this fact. And we feel very comfortable having that. And even with that significant underweight, all throughout 2025, we were delivering double-digit returns in the calendar year because of our allocations across a variety of other assets that performed extremely well, in some cases much better than the S&P 500 and even NASDAQ. So it's important to remember that it is a global capital markets, and that's really our focus here is as global macro investors. We are interested in the opportunities that are present in a variety of other asset classes away from just what may seemingly be the only game in town. There's plenty of other opportunities for growth in the markets, thankfully. And the last item is thinking about the erosion of the US dollar. Maybe there's further devaluation to come. And if that's the case, be very mindful of how much US dollar asset exposure that you have. As a US-based investor, certainly most of our investors are US-based investors, we're able to diversify them internationally, owning assets in other types of currencies so that they're automatically getting the benefit of US dollar devaluation by owning the equities of these other companies located in other countries, in euro-denominated assets, UK-denominated, pound-denominated assets, yen. And so is the dollar going to continue to decline? And if we look at some of the decisive actions, and forget about the politics regarding those decisive actions at the beginning of this year with Venezuela, is that going to create more certainty or more uncertainty with global geopolitical risks? In our assessment, it certainly creates more uncertainty. I would say it creates maybe more certainty on one hand, because now you really see a particular theme coming out of the US, but that theme is actually fairly disturbing because it rocks the boat quite significantly from the status quo. And so the uncertainty comes from the reactions to that. And so one of our themes and thesis is that this will continue to create pressure on other countries around the world to evaluate their supply chains. And if they've already, and many have, been shifting supply chains away from the US because of a variety of reasons, like tariffs, for example, and the pressure that's put on them, so finding other countries to trade with and grow their businesses with seems quite reasonable because there's less geopolitical tension and risks in those avenues. So those are the three big themes. Be on the lookout for my Forbes article on the subject in the next couple of weeks. And in the meantime, if you have any other questions, always feel free to send us an email, and you can go to our websites, and there's a link available in our YouTube channel for you to check that out. And you can subscribe certainly to this channel as well, so that you can keep up to date on our thinking, our analysis, our research, also portfolio actions that we may be taking for our client portfolios. But thank you so much for joining me, listening to this update. Try to keep it less than 10 minutes today, and have a very healthy and prosperous 2026. Thank you.